conventionally, compared to others, the private sector has a greater risk-taking ability.
Even today's newspaper, for example, has an article on Siemens wanting to come to India, and that's consistent with, companies like Foxconn, Xiaomi.
The GDP deflator is closer to WPI, which is running a negative, and CPI is down by almost 3%. That the case for monetary relaxation is fairly strong.
GST is imperative. I don't think there's any two opinions on that.
We have been protected because of our strong fundamentals from the China situation.
Well, the economy is slowing and stock markets are sputtering. Add to that the crisis in China. Amidst this backdrop, the Prime Minister today met the who's who of India Inc. to take stock of the situation. Good evening. Thanks very much for joining us on India Business Hour. Take risks and start investing. That was the clear message from the Prime Minister to India Inc. The second high-profile meeting with the Prime Minister and India Inc. in 2 months.
And boy, did India Inc. have a long list of demands. The top one, of course, being to the RBI governor to cut rates.
Absolutely. A polite clamour to cut rates. And sources say Governor Rajan, who was at that meeting, stopped short of responding or wasn't drawn into the rate cut debate. But a detailed report is coming up. Before we get you that, here are the other headlines we're tracking this evening. Bulls find some breathing space on Dalal Street. A rally across the globe lifts sentiment. The Sensex surges over 400 points. The Nifty moves closer to 7,700. The Rupee gains marginally against the dollar.
Shares in Shanghai rise. China announces more measures to stem volatility. It's a rally on Wall Street as the Dow surges over 250 points at open.
So I'm very, very excited about it, and I really like to spend the money because the opportunities are there.
Siemens promises to pump in big bucks into India. The global CEO pledges to invest €1 billion in the next 5 years. That's a CNBC TV 18 exclusive.
Infosys gets a clean chit in the H-1B visa case in the United States. The Labor Department finds no violations in its probe, which began in June.
ITC moves to ramp up its FMCG business, plans to set up 3 new factories by the end of this fiscal. On the other hand, HUL sends modern bread to Niman Foods.
JSW completes the acquisition of 2 hydropower plants from JP Power for 9,600 crore rupees. Also signs a binding agreement to acquire a 3rd plant as JP Group steps up its debt reduction drive. The Maharashtra government faces criticism from all quarters for the 4-day meat ban in Mumbai during the Jain fasting season. Even ally Shiv Sena questions the move. Rakesh Maurya is moved out as Mumbai Police Commissioner but brought back within 10 hours to head the Sheena Bora murder case till a charge sheet is filed. Ahmed Javed, who replaces Maurya, retires in only 4 months' time.
Also on the show, 4 out of the 7 Indians who feature on the 9th edition of the Forbes Asia Philanthropy list are co-founders of Infosys.
And we take you inside the Jatiya House in Mumbai's Malabar Hills, the costliest address in the city, after Kumar Mangalam Birla laps it up for 425 crore rupees.
I've always been interested in property. I'm an investor in Australia, and I've seen the massive changes in India over the past 10 to 20 years, particularly the last 5 or so years.
And it's Steve Waugh, second inning. The Aussie cricketer launches a realty portal for NRIs. All of that and more coming up for you in just a bit. But the big story tonight, the global turmoil, the slowdown in China, the sharp cuts on Dalal Street, and a general sense of despondency about growth and reforms. All of this prompted the Prime Minister to call a high-level meeting with the top brass of government, the RBI governor, and leaders of India Inc. Over a 3-hour meeting, industry pitched for a cut in interest rates, sought intervention against dumping of cheap imports, as well as steps to boost consumption. The Prime Minister reiterated the strength of the India story and has pushed industry to start investing once again.
A show of strength, signs of nervousness, or a little bit of both. These images of the Prime Minister playing host to the country's top industry leaders, bankers, economists alongside his key cabinet colleagues and the RBI governor captured the attention of the markets this morning. In a 3-hour meeting, captains of India Inc. raised a whole host of issues, but sources say the high cost of capital was high on the list of concerns. A polite clamour for a rate cut failed to evoke a response from the RBI governor. At a post-meeting briefing, the finance minister acknowledged the demand.
There were the individual participants from amongst the industry and the economists. Some of them did make that suggestion.
Besides rates, we learned leaders like Cyrus Mistry raised the issue of high distribution and logistics costs. There was even a call for strengthening our anti-dumping mechanisms to protect industries like steel from cheap imports.
There were some discussions about moving more quickly as far as safeguards are concerned. And of course, there was a long discussion about how to move forward on stalled projects. So those were the items that we discussed that would assist the economy through this short-term turbulence.
We learned leaders like Sunil Mittal raised concerns over the control norms governing FDI in the insurance sector. There was also a call to unshackle the education sector and allow FDI. Sources say SBI Chief Arundhati Bhattacharya drew the government's attention to the issue of stressed assets, especially in the textile, steel and discoms. Industry also called for more action on stalled projects and the ease of doing business.
China will be vacating a lot of spaces. We could look into that. But as a prosperity or as an opportunity for the country only. And the second one was the ease of doing business. Little more needs to be done. A lot has been done, little more needs to be done. Take further steps in de-stressing bank balance sheets, and there is a correlationship between stressed projects and stalled projects. So completing those with last mile funding so that these projects achieve financial closure was one headline point.
The most important thing that came across was, of course, lack of infrastructure, which makes us uncompetitive completely. So that was one point. And from FICCI, I raised 2 points, and one of them was the access and the cost of capital.
While no fiscal incentives were discussed or concrete assurances given, the team from North Block allayed growth concerns.
India does stand out. All the projections that you see is going to be the highest growing country amongst all the major economies, and that's a fact that means that India is going to remain a relatively attractive investment destination.
While the government may have tried to talk up the economy and the markets, the underlying message from the Prime Minister is clear. Industry must start to invest as well. After all, no one likes fair weather friends.
The Prime Minister's second meeting with India Inc. as early as 2 months. And we spoke with the SBI chairperson Arundhati Bhattacharya. She said the government was responsive. However, it failed to respond to any of the suggestions that had been made. It was more of a brainstorming session. Moving on to the Dalal Street, after days of struggle, the bulls finally got some respite. A relief rally across the globe also helped our markets to bounce back. Sensex rallied over 400 points to climb back above 25,000. Nifty surged over 120 points to move within kissing distance of 7,700. Mid-caps got some relief, but the gains in that index were limited. Anuj Singhal joining us to wrap up the market action. Anuj, how would you describe it? Is this a dead cat bounce?
Well, whether it's a dead cat bounce or whether it's a bottoming out process for the market, only time will tell. For now, you have to say that it was a bit of a counter-trend rally. The markets were oversold and were ripe for a bit of a bounce back, and that's what you did. Also, keep in mind that the global markets also rallied today. So India was not alone. Chinese market had a big intraday reversal. That had a large part to play in our markets gains as well. And in the second half, European markets were trading with big gains. The Dow futures were trading with 300-point uptick. All of that led to the kind of sentiment that we saw the kind of rally in the second half. But again, one swallow doesn't make a summer, so that's something that we have to keep at the back of our mind. Let's talk about the stocks, because it was a large cap driven day, especially for the banks. Mid caps again underperformed today. So bank stocks did well, private banks in particular. ICICI Bank contributed more than 25% of Nifty's rally, up 5%. Axis Bank 5% as well, and Yes Bank was up about 7%. Even the PSU banks rallied actually. PNB, SBI, Bank of Baroda, all of them up about 3 to 4% in today's trade. Apart from that, some other prominent Nifty winners included stocks like Larsen & Toubro, Tata Motors, BHEL, all up between 2.5% to 5.5%. Commodity stocks did well today, led by Tata Steel. That stock was up about 6%. GAIL was up 7%, and Vedanta was up about 4%. There were only 3 or 4 losers today on the Nifty, so stocks like Hindustan Unilever, Kane and BPCL were on the losing side. And in the mid-cap basket, not too much of outperformance, but there were some stocks that still stood out. JSW Energy was up 10%, NCC was up 7%, and Indiabulls Real Estate was up 5.5%. The next 2 days would be the real test of the trend of this market, because, as I said, one swallow doesn't make a summer, and that's something that the bulls would be wary of as we move forward.
All right, Anuj, many thanks. So we see a relief rally for our markets today, and at least now the global markets seem to be moving positively, so that bodes well for our markets. Of course, it all depends on how the US markets finally close for the day. But let's shift focus now to Mint Street, where the currency showed some resilience today with the equity markets picking up, and the rupee snapped its 3-day losing streak, ending 28 paise higher, just above the 66.54 mark to the dollar. The turmoil in China is bound to spread across the entire Asia-Pacific region, and that's the word coming in from rating agencies as well as big global brokerage houses. Moody's and UBS have gone ahead and cut the growth forecast for the entire region. That means India and China included. Ekta is standing by with the details. Ekta, let's start with what Moody's has had to say.
Well, Moody's has lowered the APAC growth forecast for this as well as the next year. The move, according to them, illustrates the outlook in the region and in the other parts of the world. Weak demand from China has dampened overall export outlook for the region, according to them, and softer commodity prices will possibly weigh on some sovereign export revenue, external positions, as well as fiscal balances. So overall, Moody's already had cut India's GDP forecast, but just to reiterate, for 2015, it stands at 7 versus 7.5%, and for 2016 it stands at 7.5 versus 7.6% earlier. For China, the growth forecast for 2016 is cut to 6.3 versus 6.5%, and APAC, which is ex-China, India and Japan, the estimate is that it will possibly slow down to 3% versus a 3.6% forecast earlier for 2015, and for the next year 3.2% versus 4% growth forecast earlier. UBS also additionally has reduced India's GDP growth forecast to 7.1 versus 7.5% earlier, and they've reduced the Indian GDP growth projection to 7.6 versus 8.3% for the next fiscal as well. According to them, the June quarter GDP at 7% and GVA at 7.1% challenges expectations of acceleration of growth in 2015-16. Disappointment comes despite lower oil prices, which were expected to provide boost to the Indian growth and balance sheet repair led by lower oil prices and lower interest rates. However, are expected to support in terms of acceleration of growth in 2016 and 17.
Right, thanks Aditya for joining us. With that, on to global shows now. We'll begin with Asia. China's Shanghai Composite ended 3% higher, and it was a very volatile session. In fact, most of those gains came in the last few minutes of trade. The Hang Seng in Hong Kong, that was up by over 3% in trade, or 675 points. The Japanese Nikkei ending with sharp losses, and that was the one index that was in fact in the green, the only index in the green yesterday in Asia. And from Asia to Europe, or European equities extended gains today, despite the weak export data that had come in from China. That did also added to volatility in Asia. The German DAX, that rose by 162 points. British FTSE having a good day, up by about 72 points. Even the French CAC comfortably up by about 1% in trade. And Shireen, Wall Street back from a long holiday.
Absolutely, and it's looking good on Wall Street for now, at least as far as the S&P 500, the Dow Jones, as well as the Nasdaq are concerned, all trading with gains of about 1.5% to 2%. And the Oracle of Omaha is speaking to our colleagues in the US. Warren Buffett saying, I've still got money left to buy. I like down days. I buy stocks I want. And he believes that 2016 will be higher as far as the stock markets are concerned. Here's the Oracle of Omaha, Warren Buffett, in conversation with CNBC.
Pre-2007 period. All of those things add up to a great economy, and yet the market's volatility could be something that would keep the Fed on pause. How do you kind of do the calculus on this?
They've never asked me to be a member of the Fed. Maybe they think I know anything about it, and they're correct. I've always thought they'd be slow just because of the effect on currencies around the world if our interest rates keep getting stronger when Europe is trying to keep them low. One thing you have to be a little careful about in GDP statistics, when we talk about earnings of companies, we're always talking this year versus last year. If we say they're up 5%. With GDP, when we talk quarterly, we're talking about sequential. If you look at year-over-year figures on GDP, they're 2 and a fraction percent, and they've been that way quarter after quarter after quarter. But the quarterly figures, when you multiply something by 4, little changes get multiplied a lot. So the seasonal adjustments, both of the current period and the last period, they can throw those quarterly numbers off a lot when you report sequentially. I think, in a way, it's better to look at them year over year. And year over year, we've been in the 2 and 2.5% range now for, I don't know, 6 quarters or something like that. So I would be a little careful in getting too excited about quarterly statistics in either direction, as long as you're looking at them sequentially.
So you think the economy is not necessarily as strong as the most recent numbers that we've seen?
I think we're still on that path we've been on for 6 years, where it's growing at 2 to a little bit better than 2% annually, and that's not a bad rate, but it's not a booming rate either, and I think that's about where we still are.
So it may not be a booming rate for the economy, but it's probably also not an economy that warrants 0% interest rates. I mean, that's a fire sale, that's an emergency sort of situation. Why not move off of 0?
They probably will. I don't know. I mean, but like I say, if our rates got substantially higher than Europe's, I would not think that would necessarily be good for exports for this country. I mean, in economics, you can never just do one thing. There's always and then what. And I think the and then what of moving rates up substantially while Europe's trying to keep them very low could have some consequences down the line.
You think this Fed has a different job? Have things really gotten that much more global and kind of out of the Fed's control?
I think they have to think about everything. I mean, that's their job. And they're looking at a lot of things that I'm not looking at, and they get better information, I'm sure, on lots of things. So I don't envy their job. And they, to some extent, maybe by their commentary, they sort of push themselves into something where they have to do a little bit something here. But I would not be terribly aggressive if I were in that position.
So there are some people who are in the camp of raise at 25 basis points and then back off and don't do anything for a long time, which is fine in theory, but the market doesn't know exactly what you're doing until they watch on a day-by-day basis.
I've never made a decision based on what I think the Fed is going to do near term or longer term. I mean, it just does not enter. When we decided to buy Precision Cash Parts, there wasn't one word of conversation with my partner Charlie or with our board of directors about Fed action.
However,
and the same thing goes with our purchase of Phillips Petroleum. Phillips 66.
In May, when I spoke with you and Bill Gates in Omaha for the Berkshire annual meeting, you both said that whether the stock market was fairly valued or not depended on what happened with interest rates.
Correct.
So if interest rates go up from here, does that change your perspective about the stock market overall?
Not if they go up 100 basis points. If they go up 400 or 500 basis points, it changes a lot.
But at this point, even if we were to see 100, like a 1 point.
Basis points is not stocks. If interest rates, if you guarantee me interest rates would be at 100 basis points higher than this for the next 20 years, I'd be buying stocks hand over fist.
We know that there are a lot of stocks that you've been involved with. Bank of America is one of them. I think you own non-voting shares and warrants.
Yeah, non-voting shares.
So you won't get the chance to vote on this, but we'll ask you your opinion anyway. At Bank of America, there's been a lot of turmoil about the idea of Brian Moynihan taking the role of both CEO and chairman. It went against a 2009 proxy vote, that was to keep those two roles separate. Now they're going to be asking shareholders directly. What do you think?
Well, if I could vote, I would vote as management suggests, which is to have Brian take on the CEO and chairman job.
Are you bothered by the idea that of just how it was done, how the board did this and ignored what was a binding proxy vote from 2009?
Well, I guess they're putting it back to the shareholders now. So I'm not bothered. I do not think that's a big deal. I think that what Brian has done. He took a company that was just a terrible mess. I mean, it's been virtually destroyed. The public hated it. The government hated it. They had all kinds of lawsuits coming in. The employee morale was terrible. And he's resuscitated, and I think he's done a first-class job. And if he's the chairman as well as the CEO, God bless him.
It was a company in crisis, and as somebody who's been in business for a long time, you've been through a crisis or two yourself. And I think you've even come up with a motto that you tell people to stick with. Get it right, get it fast, get it over, but get it right first. And that's
you got to get it right, then get it fast, get it out, and get it over. I mean, but you got to get it right first, and that's what he's worked at doing.
Mm-hmm. You think that's what Hillary Clinton has done with the email situation?
Well, that's slippery. I would say that no. I would say that it was a mistake. It was a mistake to have the private server, and I think it was a mistake. In the first talk, she acknowledged the fact she would have done it differently or anything. I think it's better just to be very blunt in those kind of situations. Say I made a mistake, and fortunately, then not result in any breach of security or confidential. But the best thing to do is get it behind you.
It's been months and months of this, and as recently as last month, she was making jokes about it and kind of comparing it to Snapchat. Does that bother you as a supporter?
It doesn't bother me, but I don't think it was the best way to handle it. But it doesn't bother me. I mean, what I care about with Hillary is I care about what she...
Well, that's the oracle of Omaha on a whole bunch of issues, but the headline really emerging there from that conversation with Warren Buffett is that he continues to be bullish on the equity markets in the U.S. He believes that 2016 will be a good year for the equity markets. And even in terms of what the Fed may do, will the Fed hike or not hike, whether it's September or December, not too perturbed by that, believes that unless and until the Fed is aggressive in hiking rates, it's not going to change the valuation story. We'll get you more from Warren Buffett in just a bit on India Business Hour. But on to the commodity corner, a quick check of how Brent and NYMEX prices are trading on the back of all the economic data that we've had to contend with. Brent now 3.5% higher, and NYMEX crude is trading about 0.5% higher or so. Heading back home, we're committed to invest €1 billion in India by 2020, if not earlier. That's the word in from the Siemens Group. Joe Kaeser, the president and CEO of Siemens, sees India as one of the most exciting opportunities today and has high hopes from the healthcare, railways and other sectors. I caught up with him earlier today and started by asking him about the India investment blueprint that the global board of Siemens, which is currently in India, has come up with.
Well, first of all, I mean, we've been here for more than 100 years, and the excitement has always been similar. Today, I think it's just a different period of time. You know, there is a prime minister, there's a new government, there is a very clear vision on what this country is going to do and what it deserves to do, what its people should be and have a better life. So it's a very exciting time. It could, you know, it could actually mark a very, very important milestone in the recent history of the country.
You know, speaking of important milestones, you've committed another €1 billion of investment into the Indian market. You've invested $2 billion over the last 10 years in India. So I would imagine this billion is going to be spread across over the next 5 years?
Well, it depends on the opportunity. It could be earlier, it could be all the way up to 2020, which has had our global managing board here meeting in India. We listened to our people, what they had to say, and the discussion and the presentation was full of opportunities. So I'm very, very excited about it, and I really like to spend the money because the opportunities are there.
But what opportunities in specific is your India team telling you about? Because if one were to look at the numbers, it's not reflecting in the numbers just yet. You know, there are concerns being raised by shareholders in terms of the capex recovery, which is yet to take off. There are concerns about Siemens valuations in India. At this point in time, what are the specific opportunities that your India team is telling you about?
I'm looking more at the opportunities of the country, and it's a measure of opportunities that they haven't happened yet, so we need to get them and need to be, you know, doing a successful conversion. Look, if I just go through the priorities which the Prime Minister has laid out, from a reliable, affordable, sustainable energy policy through infrastructure, healthcare, making in India, which is manufacturing and engineering, basically that's exactly the sweet spot of our company. That's how we have organized it, that's how we've been successful over the years. And Siemens is a very global operation, and that's also the beauty for Siemens India, for Siemens Limited as a what you said, public company, because Siemens Limited India can bank on the global support of our company.
Right.
So that's why I guess the opportunities are there, and we have a lot of optimism to get them.
Okay, you know, let me just take that point of optimism forward, because clearly you do believe in the India story, which is why the entire global board of Siemens is here. But again, if I were to go back to the numbers, and I was just looking at the kind of earnings performance that Siemens has actually seen, earnings have fallen by 10%, and I'm talking about the FY09 to FY15 period, so this is not 1 or 2 quarters that we're talking about. The order inflow continues to look weak. Even in the last quarter, there is no visibility in that sense of orders really picking up. What is the sense that you're getting in terms of actual order inflow? Because revenue visibility is now a question mark that analysts are talking about.
Well, first of all, if you talk about business in India, this is not only about Siemens Limited, this is about how we can support the market in India from a global perspective. So that's, I think, is a big difference. Secondly, if we really look at the numbers of Siemens Limited India, I think they also have been reflecting, you know, the course of investment, infrastructure investment in the country. And now with the new vision of the Prime Minister, with the new management team in Siemens India, we are exactly at the inflection point that we have been turning around the growth momentum, and we expect actually the company to grow again, like for like, in 2015, and we expect that to continue going forward.
This is size of the conversation we have with Siemens. Big plans for India, want to spend about €1 billion in the next 5 years, if not earlier. Moving on, Jatiya House in Malabar Hills, Mumbai has just become the most expensive bungalow in India. Kumar Mangalam Birla will soon complete the purchase of that iconic structure at a whopping 425 crore rupees. CNBC TV 18's Alexander Matthew managed to get you some exclusive visuals of that bungalow.
I'm standing inside the premises of Jatiya House that has just set the record for the costliest residential property to be sold in Mumbai. It was bought by Kumar Mangalam Birla in an auction very recently. Sources have confirmed to us that he's already paid the 10% booking amount, so it's only a matter of time before Mr. Kumar Mangalam Birla takes possession of this property. And I'm just going to show you some of the exclusive shots that we've got of this beautiful building right over here.
Jatiya House, which has a built-up area of around 30,000 square feet, is spread across 3,000 square meters. It is 25 crore rupees costlier than Maheshwari House, which previously held the record and which was bought by Sajjan Jindal in 2012. And just a short distance away is the famous Mehrangir, for which Adi Godrej paid 372 crore rupees. KM Birla reportedly outbid 5 bidders, including Ajay Piramal's Piramal Realty, to acquire the property from Y. Jatiya, who has held it since the 1970s. In Mumbai, Alexander Matthew.
Well, that's no longer the Jatiya House, it's now the Birla House. But on that note, it is time for us to wrap up this edition of India Business Hour. We will continue to track the market action for you. Will the relief rally continue? Will the markets extend their gains or not? And of course, a crucial cabinet meeting tomorrow. So stay tuned to CNBC TV 18 for all of that and more.